Assalamu alaikum, distinguished panelists and esteemed participants. I offer you a warm welcome to the 17th BDRL monthly webinar. I'm Samira Sohani, your host for today's session. I'm currently working as a research associate and also playing the role of the acting head of research, advisory, and training unit of the Bangladesh Rating Agency Limited. Thank you all for joining us for this enlightening discussion on development of bond market in Bangladesh, prospects and challenges. So before we begin, let me take a moment to introduce our esteemed panel of speakers. So we have the privilege to introduce our keynote speaker, a very eminent professional, Dr. Sadia Afrin. She is a financial sector specialist, finance competitiveness and innovation, global practice at World Bank Group. She was a visiting fellow of Australian South Asia Research Centre, Australian National University. She is a former joint director of Bangladesh Bank. She has completed her PhD in economics from ANU and completed her master's and bachelor's from University of Dhaka. She has also completed another master's degree from Australian National University in International and Development Economics. So welcome to our webinar, ma'am. So we are also very deeply honored to have a very knowledgeable academician and professional Professor Dr. M. Sadiqul Islam. Dr. Sadiqul is a professor of Department of Finance of Dhaka, University of Dhaka. He is an independent director of RAW BHZ Airtel Limited, independent director of Red Dot Digital Limited, independent director of United Airways Limited, independent director of Walton High-Tech Industrial Limited. So Sir has completed his PhD from Athens University of Economics and Business. He has completed his MBA from University of Saskatchewan and MCom in Finance from University of Dhaka. So we are very, very much privileged to have you with us, sir. And then we have our second panelist. We are also very deeply honored to have Mr. Muhammad Tajul Islam. He's a founder and chairman of Barik and Connect Limited, sponsored director of Mongolian Investment Rating Agency. He is an executive director of RSA Capital Management managing director of Blue Wealth Asset Management Company. He is a former risk management specialist in Asian Development Bank, Manila, Philippines. So welcome to our webinar, sir. And last but not the least, we have our Honorable Chief Executive Officer, Dr. Syed Abdullah Al Mamun, FCMA, as the moderator of this program. Apart from being our CEO, Dr. Mamun is an independent director and chairman of Audit and Finance Committee of Board of Director of Northwest Power Generation Company Limited. He is an independent director of FS Finance Investment Limited. And Dr. Mamun is also a certified professional cost management accountant and a fellow member of Institute of Cost Management Accounting of Bangladesh. So we are very honored to have such esteemed professionals with us today who will share their insights on development of bond market in Bangladesh, prospects and challenges. So to dive into the discussion, I would like to request Dr. Syed Abdullah Al Mamun to take the floor. Over to you, sir.
Thank you, Samira, for your nice introduction. So welcome to all of the respected panelists and the participants of today's session. So here I'd like to take the privilege to introduce Bangladesh Rating Agency, that's in BDRL. Can you see my screen?
Yes, sir.
Okay. So the backdrop of today's webinar, monthly webinar, is to deliver the contemporary issues of business and economics. And the BDRL monthly webinar is the platform where industry experts shares their knowledge and participants get the opportunity to listen from them and to extend their understanding through interaction and the inputs from their opinions. As per our regular program, the last 2 years, we are persistently organizing the monthly webinar on the different contemporary issues as per the obligation as a credit rating company to create such a platform. And in this process, the bond market is a very burning issue, as well as is a very critical issue for the next steps of Bangladesh and is expanding economic activities. Considering that importance, we have chosen this topic today, and we are privileged to have our eminent relevant experts from whom we will listen and being enlightened. So here, BDRL, the Bangladesh Rating Agency Limited, is a subsidiary of the Dun & Bradstreet company, which incorporated in Bangladesh in 2008 and licensed by BSEC, Bangladesh Securities and Exchange Commission, and also accredited as an ICAI from Bangladesh Bank, the Central Bank of Bangladesh. It focuses on the three main line of business. It provides credit rating services, advisory services, and research and the training activities. And these are our also institutional shareholders, participants of Bangladesh. All are the eminent financial institutions along with the Dun & Bradstreet. And our parent company, Dun & Bradstreet, is the 200 years American company, which was established in 1841. And it has a very rich legacy with the information that, like, the ex-4 American president were the employee of the Dun & Bradstreet, and currently almost 90% Fortune 500 company rely on the Dun & Bradstreet data. And we have almost 530 million business records up to the date. And Dun & Bradstreet South Asia Middle East Limited, who looks after the operations of the South Asia, Middle East, and Africa, having the 67 markets with the headquarters of Dubai. And Dun & Bradstreet SEM has the 7 operating product lines, that is the risk management solution, credit rating, credit bureau services, sales and marketing solution, economic analysis group, research and advisory services, and fintech solution. And the key focus or key engagement of the BDRL, as I mentioned, is a credit rating, advisory services, publication, research, and training. And our credit rating services covers the wide range of the services, incorporating entity rating, bank and financial institutions rating, bond rating, insurance rating, NGO and the microfinance institution rating, project rating, SME rating, bank loan rating, and also personal rating. And BDRL credit rating has its own uniqueness, and it provides independent opinion. At any means, we do not compromise the position and try to provide unbiased credit rating opinion. And all the analysts are chosen from the best talent pool of the available to us and trained continuously through international platform as well as in local experts. And insights, the rating always provides the insights for the financial strategy formulation that goes beyond the use of only rating as a symbol. And we try to provide the inputs through our analysis to the business decision maker so that they can use that inputs for their business decision making, and also to set their future strategy, taking the inputs from our reports. And our other service incorporates, as I mentioned, advisory services, comprises due diligence, ESG advisory, management advisory, and the rating advisory, industry analysis, economic analysis, and the impact studies have been conducted. And also we have a wide range of relevant training related with the with our expertise, that is in financial statement, risk management, and business strategic analysis and business analysis, also valuation. And so far up to today, We have provided a wide range of services incorporating almost 40,000 SME entities have been rated by us for the last more than a decade, and more than 350 companies have been rated. And also our advisory service also provided in more than 650 companies, and also more than 8,000 companies have been given for last more than a decade to the different types of advisory services. And the underlying philosophy of BDRL as a DNB company to find the truth from the data. So we have data, but we try to explore the truth as maximum as possible, the realistic way. And as I mentioned that, like, we try to explore the better insights so that it can be used by the business decision maker for their better business decision-making process and can drive their sustainable growth. And as a whole, we intend to contribute in the sustainable economic growth as well. And today's topic, that's the development of bond market in Bangladesh, prospects and the challenges. Here, the major objective to choose this topic, because our economy is expanding so fast, and to need the appetite, growth appetite of the economy, we need to supply the best way of supplying fund. So here, bond is one of the best options for meeting the expanding appetite of the fund. And it has, but the reality is that our market suffers from some obstacles for developing the bond market. So today's experts may enlighten us how we can overcome those challenges and exploit the prospect of meeting the expanding demand of the fund. So welcome again to all of you. And now over to the Samira.
Thank you so much, sir, for presenting such a wonderful presentation demonstrating about BDRL and DNB as well. So now I would like to invite Dr. Sadia Afreen to share her thoughts about the topic development of bond market in Bangladesh, prospects and challenges. Over to you, ma'am.
Thank you, Samira. Distinguished panelists এবং আরো যারা জয়েন করেছেন সবাইকে শুভেচ্ছা। এখন সবাই অফিস থেকে ফিরেছেন। Many of you have long day at office today, so I'll try to be very brief in my presentation. I have a short presentation. Let me try to open it. Can you see my slides?
Yeah.
Okay. So I will first briefly discuss on the overview why we are talking about bond market, and then a few key issues in the demand and supply side of bond markets. And once we know the issues, then we can talk about what we need to do. So I will proceed according to this plan. So we know that the government of Bangladesh envisions to become an upper middle income country by 2031. And accordingly, they have a perspective plan 2041, that has three overarching targets. First is becoming an upper middle income country by 2031. And second is eliminating extreme poverty by 2031 and achieve high income country or a prosperous country status by 2041. The implementation of this perspective plan is envisaged in 4 5-year phases. We know that we have 5-year plans, and the first phase starts with 8 5-year plan, which is the current one. And there it mentions that the plan has 7 pivotal themes. So I have started with what is the national strategy, right? So there are 7 pivotal themes there. One is promote labor-intensive, export-oriented manufacturing-led growth. So it's labor-intensive, export-oriented manufacturing-led growth, along with expansion of the domestic market. And then agriculture diversification, bringing dynamism in MSME sectors, and strengthen modern services sector, push export of non-factor services, and promote ICT-based entrepreneurship, and strengthen overseas employment. So as you can see, many of these themes requires financing. We want to be a leading export-oriented countries. So we need financing. Without having adequate financing instruments or solutions, it is difficult, right, to promote the growth in the real sector. So far in Bangladesh, the growth has been very much on bank finance dependent. In terms of the financial overall financial sector assets, bank hold the majority part. And banks, we know that banks are constrained by short-term liabilities. With short-term liability, they finance long-term assets. So it is not possible for banks to finance the long-term capital needs of the real economy to fulfill the growth aspiration. And we know that one of the main reasons of the current vulnerability or fragility of the financial sector, or the banking sector to be specific, is the asset liability mismatch. I know there are many other reasons, poor governance, political influences, and many other factors, but asset liability mismatch is one of the main reasons behind the current fragility in the banking sector. NPLs ratio reached to 8.8%. So this is the official non-performing loans ratio. And we know that I would say this is grossly underreported because the non-performing loans classification criteria that is being followed by the central bank in Bangladesh is much more lenient than IFRS 9 recommends, or what is the Basel recommendation or international good practices. So the true non-performing loans or stressed assets is actually much higher than what is officially reported. Our private credit to GDP is 33.9%, much lower than even many of our neighboring countries. And the stock market capitalization to GDP reached to only around 28%. So in this table, I put India just as an example of a neighboring country. We see our banking sector assets is 54%, much lower than India. Private credit to GDP, it's very small. It's even less than 34%. And capital adequacy ratio. We know that the minimum capital adequacy ratio is only 10%, and including the capital conservation buffer, the requirement is 12.5%. So overall, the banking sector's capital adequacy is barely meeting the regulatory minimum requirement. So with this status, or with this level of strength of the banking sector, it is not possible to finance the growth aspiration that the nation has, right? To become a middle income, upper middle income country by 2031, or becoming a prosperous country by 2041. So we need something, some more instruments, some different source of financing, so that the next phase of growth can be financed. That's why we need bond market. So this is an essential, it's a critically important topic to discuss. And we see that in national strategy, government is emphasizing on developing long-term finance market, and international development partners are working with the government to create better enabling environment in the bond market. If we look into the other Asian markets and compare with Bangladesh, we see that our position is really at a very nascent stage. So this is Indonesia, Vietnam. We see even Indonesia, it has 2.4%. So this the orange rectangle, this is for corporate bond market, and the white rectangle is for the government securities market. For Bangladesh, this is only 0.3% of GDP. In some sources, it is even smaller than 0.3%, so not even 1%. So we see how nascent or how underdeveloped the corporate bond market is. So we agree that we need bond market as a solution to develop our long-term financing needs. Before talking to the corporate bond market segment, I will briefly discuss the government securities market and the related issues with public debt management system. We noted that the government was able to maintain its debt, its fiscal deficits within 5% of GDP. Although it's a difficult time around the world, right? There are inflation everywhere out of rising commodity price. All the leading central banks are changing their policy rates frequently. So it's a volatility of the global financial conditions and slowdown of growth of major trade partners. But it's still, our fiscal deficits are still at a reasonable level, I would say, compared to our neighboring countries. However, we note that government has resorted to more monetary financing in recent years. And we know that this has a negative implication for inflation. The central bank's target is to contain inflation, but if government continues to borrow from the central bank, it will increase money supply and it will make controlling inflation very, very difficult. In terms of the public debt management, there are some key building blocks, right, that needs to be improved for a government bond market to develop. And why we are talking about government bond market? Because government bond market provides the benchmark yield curve for the corporate bond market sector to use and adequately price their instruments. So that's why government securities market is very important to develop for any country. It's the fundamentals. The few key issues that we think, I think that's very important to develop in public debt management is having a reliable yield curve. We know that there was an interest rate gap in the banking sector, and the gap was de facto exercised for corporate bond market as well. And Bangladesh Bank has started trading of government securities in the secondary market only very recently. So they have started to develop a yield curve, but it will, I think, take a little bit more time to get a reliable yield curve. And BP development practice, because government securities are often issued not on market-based, right, on demand and supply basis. Therefore, Bangladesh Bank often has to devolve the issue on the primary dealers. Why Bangladesh Bank needs to do it? Why it is not market-based? There is a big distortion by national savings certificates or Sanchoy Potro and this has the open tap policy. What government does is there is no control or maintaining a limit on NSC issuance. So in every year, they issue as much demand they face, and the remaining of the budget financing comes from the government securities. So therefore, there is no, government securities works only as a residual. So therefore, it is hard to predict the government issue calendar, and the price discovery is also not perfect. So this makes government securities market really less functioning, and Bangladesh Bank is often forced to do development on the primary dealers. So these are the important issues that needs to be improved. And market signaling, second is market signaling and predictability of the issuance calendar. So as I said, the national savings certificates or Sanjoy Potro is a big distortion here. And another issue is it is often very difficult to predict the cash flow management from different ministries. This practice needs to be improved. Otherwise, the Ministry of Finance, they in the middle of the year, they may receive a higher or lower demand of cash from ministries. So it is difficult for them to manage the calendar, to follow the calendar that they announce at the beginning of every month. So this is the third issues. The third issues is the primary dealer system. I will not go much detail on each of these issues, but I think that these are some of the key issues on government debt management system that are very important to develop government securities market and offer a very reliable yield curve that can support the corporate bond market to price their product appropriately. Here some historic data on corporate bond and debenture issuance. You see in the latest 2021-22, there were only 26 issuances of corporate bond, and out of this 26, I think only 4 or 5 issues were from the corporate sector. The rest came from banking sector. So the total number of corporate bonds that are being issued every year is for meeting the regulatory capital ratio. Usually one banks issue bond and other banks just invest it. So this is within the banking sector. But we want the real sector issuers to come and issue bonds, right? So this practice, this needs to be changed, and certainly there are issues in both demand and supply side that needs to be addressed. I think the last fiscal year, I checked data in BSEC from 22 to 23 June. Sorry, there were probably only 4 issues from non-financial corporates, and the remaining were from banking sector. And we see there are no debenture issuance in past 5 years. So in terms of the types, we see that banks usually issue subordinated bonds for raising their tier 2 capital and perpetual bonds for tier 1 capital. And this zero coupon bond, this is very popular in the few non-financial corporates issuer. I mean, the few bonds that are issued from non-financial corporates, mostly it's zero coupon bond, maybe because of the tax incentive. Among the issues, we consider some are overarching that affects not just the bond market, but also banking sector. The first one I would say is the coordination between the regulators, Bangladesh Bank, BSEC, NBR, and Ministry of Finance. So all this agency, definitely there are a scope to improve better coordination. Sometimes simple problems can be solved by talking to each other. And as a Bangladeshi, sometimes we lack better coordination. I mean, this is something we need to work out, right, to improve. Because we want to develop bond market, but we are so much dependent on the banking sector. And the banking sector, banking regulators may think that, well, we cannot develop bond market, capital market, undermining the interest of the depositors. So of course, there are ways to do things better, right? Ensuring securities or safety of the both parties. So we need better coordination. We need to understand each other's challenges, each other's regulatory purview to coordinate better to solve problems. Second is the caps, interest rate caps or corridors. I know very recently Bangladesh Bank has introduced corridor, interest rate corridor, but until I think it started in February 2020. And until the latest monetary policy announcement, there were interest rate caps, and this cap was killing the bond market. Although it was in the regulations, it was only for the banking sector loans, but in practice, Bangladesh Bank de facto practiced this even for the bond markets. So this stifles issuers' pricing capacity, right? If a risky borrower wants to offer higher rate, it cannot, because there were de facto cap exercised on them by Bangladesh Bank. So from the World Bank side and also IMF, we're always advocating to remove the interest rate cap. And recently, once the corridor has come, we are also suggesting that keep the bond market out of the corridor, allow bond issuer to charge higher than the corridors. So let's see, I mean, we are expecting some improvement on this point. Next is the securitization. I would particularly want to mention on the housing sector. We need to promote more housing sector, housing finance. This is another very underdeveloped area that I think we should focus on. Housing is a key area in the national development plan, in the 8th five-year plan, but our housing market is almost underdeveloped. So mortgage refinancing companies and other building blocks in the housing finance arena are currently under discussion. And once we have such mechanisms, then maybe housing loans can be pulled together and sell as mortgage-backed securities and can be traded in the bond market. But I don't know, I mean, if there are issues with securitization regulation in the BSEC, I'd be very happy to hear from the audience as well as from the panelists on this. The next point is a structural reform on the national savings certificates. I have touched upon this point a bit before, but just a little bit more on this NSC. Until very recently, private provident funds were allowed to invest their entire fund in national savings certificates. But they are the long-term investor, and they should come to bond market rather than investing their money in subsidized government securities. Yes, this is non-tradable securities. And even the insurance fund, the life insurance fund, they also keep, I'm not sure about the insurance fund eligibility in buying NSC, but for provident fund, sure, they invest 100% of the fund in NSC. So this has a very multidimensional distortion for the bond market, apart from the subsidized interest rate. And then, of course, the public debt management of the government, which I already discussed in the first slide. The next point I would like to touch upon is the institutional investors-based development. We know that life insurance fund and provident funds are the most important institutional investors for the bond market, but in Bangladesh, both of them are almost absent. For the provident funds, the issue is deeper. It's there is no regulatory authorities, right? There are some fragmented regulations like the tax rule, NBR rule, that gives tax exemption to the companies for maintaining provident funds, and the labor law also requires it, but there is no central reporting agency or central oversight authority or any investment policy that the companies can follow. Most of the provident funds are either in saving certificates or bank deposits, and even some funds are only in papers. A few years back, we conducted a study, a mapping of companies' provident funds in zonal tax offices. So the rough estimate was over $2 billion US. So it's a very rough, I would say, guesstimate. But the point is, there's a huge amount of money that can be tapped into bond market, but because of fragmented regulation or any comprehensive policy, or in absence of any regulations, any effective regulations, I would say, these funds remain unutilized. And same for the life insurance. And of course, the mutual funds is also, I understand there are some trust issues previously on the mutual funds, and there may be some regulatory issues as well that needs to be reviewed. In terms of enabling environment, definitely tax is always an issues. The bond market, they want more incentives. On the other hand, the NBR, they are in pressure to rising more revenue. They are in pressure to increase the tax GDP ratio. So this is not a very easy dialogue. It's a very, very difficult dialogue. In terms of achievement, I remember in 2019, there was a discussion on rationalizing the stamp duty on bond issuance. It was from our project that we advocated, and we worked with the tax authority, and the stamp duty was rationalized. So I think there are more areas of taxation that can be rationalized to provide better incentives. It's not that reducing the unit tax will reduce the revenue. Rather, it may help with more issuance that can increase the overall volume of revenue. So there's a bit of plus and minuses that needs to be understood by the authorities, and this is an important area for bond market. The next is the simplification of the authorization process. The BSEC Debt Securities Rule 2021 has improvement in a number of areas, but we think there is still scope to simplify the process even further. In the neighboring countries, sometimes they don't need any approval, right? Any prior approval is not needed at all for private placement. So simplification is another scope, so that the issuers face less difficulty in seeking application for NOC from BSEC. The next is the related, the current debt securities rule. It doesn't distinguish the requirement between private placement regime and public offer rules. It is the same, but I think that this should be separated, because in private placement, the investors are usually institutionals. They are already sophisticated. So they don't need the same level of protection as the public, as the investors in a public offer. Therefore, the requirement can be simplified further for private issuance. That should enable issuers to process their application fast, and also BSEC to review it faster. So the overall timeline to get approval can be shortened. Then the issue of self-registration. This is something to be considered in the medium to long run for bigger and reliable issuer. They don't need to go each time to BSEC to get separate approval. Rather, the approval can be given one time so that they can issue funds in tranches. And then the Credit Information Bureau access. By law, this is only accessible to banks. BSEC doesn't have access to it. And I have heard from BSEC many times that getting CIB clearance from the central bank takes time. So this is one area that the two regulators need to coordinate, so that when BSEC asks an information to BB, Bangladesh Bank can provide it much faster to reduce the scrutinization time. And I think this process is already much faster than before. Probably it takes 2 to 3 days for Bangladesh Bank to provide CIB information to BSEC. Next is the double approval process for bonds issuance by banks and NBFIs. So it's the it's the Bangladesh Bank's BSEC's requirement that the banks or NBFIs, they also get approval from their mother regulation. It's not just for the financial sector, but for all other sectors. So maybe in this, because this takes time, right? An issuer needs to go to both the regulator and seek approval. This makes the process complicated and time consuming. But if there are no requirement for getting approval from the mother regulator, then it would simplify the process. But for the capital adequacy purpose, any bond issuance should definitely go through the purview of Bangladesh Bank. Enable market-based pricing for non-government bond issuers, and stop setting same price. So as I said, there were a cap previously, but now the cap is lifted, and Bangladesh Bank is assuring us that they will no longer exercise cap or corridor. So banks or any issuers are free to set their price based on their own risks. So this is also critical, right? That all banks will not charge same price, will not offer same price when they submit an issue application to Bangladesh for approval. Next, I think the non-bank financial institution needs a bit liberalization, because every time they want to issue a local currency bonds, they need to go to Bangladesh Bank to seek special permission, whether it is to local or foreign. They're not allowed to do it. But given the vulnerabilities in the non-bank financial institutions, maybe in the short run, it is better to go case-by-case basis. But in the longer run, when the market is more matured and situation, of course, improves, then this can be made a general rule rather than a case-by-case approval. The next point is on concentration in large loans. So this point I'd say very interesting. I don't know why BSEC and BB, this is beneficial to both sides, because if a large borrowers can be disincentivized to borrow from the bank, they will come to the bond market. I have seen the regulation of the Reserve Bank of India, where they have a certain limit. I mean, bank always has a large borrower exposure limit set. So in case of large borrower, the RBI requires that if any bank wants to finance a certain borrower beyond that limit, it will has to maintain additional provisioning. It's a higher provisioning, and the risk weight of that loan will be higher. So this way, borrowing from bank becomes expensive. And then those large borrowers will be forced to come to the bond market. So this will help bond market as well as reduce concentration risk in the banking sector. So nobody is restricting large borrowers to borrow from bank, but borrowing from banks become more expensive. So then it would make sense to them to come to the bond market. So this is the regulation. This is something Bangladesh Bank and BSEC should consider. And then the true repo market, we already discussed this, that we need to develop a longer than overnight repo tenors. Usually in Bangladesh, it is very short term, but this needs to be a true repo market, and also the longer term tenure should be promoted. And the next point, this is related to Dr. Mamun, is the monitoring default statistics and transition matrices of the credit rating agencies. BSEC recently published the new credit rating rules, and the rules has several important improvements. And it requires that all the credit rating agency regularly publish default statistics and transition matrices, because this is something that regulators should monitor to ensure the quality of the ratings that are produced. But I don't see this is regularly published in credit rating agencies' websites. So perhaps a bit of learning is needed in the industry. I'm sure some rating agency already know how to calculate default statistics, but some may need some training. And also there may be issue of getting CIB information. To create this, you need credit information from the bureau, but access can be an issue. And the next point, well, these are related to foreign investor. We think that there can be a regulatory framework for international guarantors, local and international guarantors, to operate in Bangladesh. Recently, Guarantco is providing guarantee to some of the issues, but when the issuer pay the fee to the guarantor, it's a cumbersome process to get permission from Bangladesh Bank. So any regulation that will make the process systematic will facilitate international guarantors to operate. And of course, the green bond and thematic bonds, these are now very interesting topics. Everybody talks about label bonds. BSEC is working on green taxonomy. Bangladesh Bank has already done it for the financial sectors. So this taxonomy and having a proper framework for label bonds will help Bangladesh in issuers and investors to understand these instruments and promote this particular type of bond market. There are a few other issues that may be not so important as the enabling environment, but will facilitate foreign investors' participation, is to have authorizing the local issuers to be able to issue local currency bond to foreign investors without any approvals required through the NITA accounts. So it's a non-resident investor TACA account. So these are oftentimes complicated and discouraging features of our financial systems. I saw a circular a few days back. Bangladesh Bank instructed all banks to automate NITA account opening procedures. We have been saying this for a while. And so this is a positive improvement, maybe, but these are the small things, right, that sometimes encourage or discourage international investors to come to Bangladesh. And foreign investors should be automatically allowed to convert US dollar to BDT to purchase the bond, and vice versa to repatriate income offshores. And of course, the hedging instruments, facilitate foreign investors to hedge investment in local currency bonds in Bangladesh using cross-currency swaps with banks in Bangladesh. So I don't think that there is no swaps in Bangladesh, but the banks don't feel comfortable to do it for the longer tenure. So this is again something to focus on, or something important. All right, so I stop here. I'd be very happy to get questions and comments from the audience. Thank you very much.
Thank you so much, Ms. Sadia Prim, ma'am. Thank you so much for such an insightful presentation and showcasing a deep overview of the bond market of Bangladesh. So to carry on our program, I would like to request Dr. Said Imamun, sir, to take over the floor of today's webinar. Thank you.
Thank you, Samira, and thank you, Dr. Sadia, who has been working for long with every aspects of the bond market in Bangladesh. And I'm a big fan of her. In fact, I had an opportunity to interact and work with her as well in this process. And particularly the way she has pointing out all the issues related with the bond market, which is fabulous. So we are really grateful for showcasing your holistic view of the ecosystem of the bond market and all parcel of the bond market. So thank you, Dr. Sadia. Now here we have two experts, in fact, two eminent experts who have a very good experience in this area and understanding. So first I would like to go to the Mr. Tajul Islam, who has been a long involvement in the credit rating as well as an international financial market. So here Sadia has also mentioned many things, but two areas I want to highlight related to the credit rating. Number one is that price of the bond will be set with the market force. So here is a risk adjusted price, we can say. So the measurement of that risk is in credit rating. So how do you assess the quality of credit rating in Bangladesh and the capability of the credit rating companies in Bangladesh to provide the credible credit rating based on which the appropriate pricing can be set? Mr. Tajul Islam.
Oh, thank you very much. Thank you very much indeed. It was a very short but very brief but very concise presentation, and also she covered almost all the things. So before I reply to your queries, I would like to give you some idea as a practitioner, not as an expert in something, because I had opportunity to work in a rating company. I had opportunity 7 years in ADB, JICA, and World Bank. Then I have also opportunity to raise local and foreign large infrastructure project bonds, and the two securitization happened in Bangladesh. I was the transaction advisor of that too, of the last 10 years. So from that perspective, as a practitioner, I give you the what are the actually real problems? The real problem is regarding the bond market. Do you hear from our FBCCI or the industrial body, did they any lobby for the bond market development? No. Why? Just give you the real fact. We have to talk the reality. All our things is okay. We understand there are problems in the rules, regulation, enabling environment, everything is there. But for the bond market, from the BSEC rules perspective, we have the finest rules, without any doubt. For the bond, for the securitization, for the sukuk, we have the finest rules and regulation. Through ADB and World Bank intervention, there are a lot of development happens over the last couple of years, including capacity into the BSEC and everything. Stamp duty and other things already had some rationalized happened, something like that. There are some tax intensive also in the zero coupon. So why not there is an investment happen? The important thing you need to understand, when you go to any corporate, why they will come to the bond market. Number one, if they feel they need a long-term tenure. That is number one things. Second, about the interest rate benefits. Third, in banks, when they take loans, if they classified, people does not know it. Only the bank and clients knows and the central bank knows. But when they expose to the capital market issuing a bond, then they're exposed to default. Their reputation will be in problem. So we have to understand the total Bangladesh financial market is based on collateral-based lending system in this country. So when you talk about the bond, it comes to non-collateralized, strength-based, reputational collateral is the important thing. Now comes to your question. So who will ensure the reputational collateral? That's why back in 15 years back, the regulators, players introduced the rating system in Bangladesh market. That was one of the reasons, because there are the two major gatekeepers who played the very vital role in bond market. One is the auditors, because the audit report, reliability of the audit report is the very critical for the investor point of view. And the second, as an investor, I don't have any knowledge to assess the company. So how can I match my risk appetite? It is the rating company coming to the picture. Now, what is the problem happens? I'm not criticizing anything. There are some regulatory arbitrage happen. Now, rating is a compliance product, not as a rating product. Because based on the market size, I'm not criticizing, there are 8 companies in here. So when you allow more rating company and they don't have any monopoly power to some extent, then there should be a rating shopping happen. It will happen everywhere. It will happen. Don't worry about this. So that is another aspect of these things. Now, people always ask the bond market, if it takes long time to get the approval from the SEC. I give you the idea. Over the last couple of 3 years, I raised more than $500 million for 8 to 10 companies. For any DFI loan, it takes at least 9 months and 12 to 15 months. If I want to go to IFC, it will take at least 9 months to get any loan. For ADB, World Bank, wherever you go, before 9 months, no money coming to Bangladesh. It is not a normal for Bangladesh. It is the total DFI system in place everywhere in the world, 6 to 9 to 12 months. So in spite of that, why the corporate are looking for taking the pain of the long-term loan from the DFI? Number one is the longer tenure. Number two is the interest rate benefit. Number three, they feel confident or their reputation if they attach with a development partner. So this is the 3 things that force corporate to go for the DFI loan, foreign loan, something like that. So the SEC took times. It is one of the problem maybe, but if the corporate people house, they raise the voice that we want a bond market, then it will be totally can be managed, all these things. So my critical question is the corporate people, they are not prepared themselves as of today for the bond market. Why? They don't want to expose their behavior pattern to the market, number one. The second most problem is the liquidity issue. As an investor, where I invest as an individual, I invest either in stock market or into the Sanchoy Potro or bank deposit. So when I would like to invest in the bond, I want to see the liquidity of the bond market. That is not available in the Bangladesh market. So now the chicken and egg problem. The problem is when my clients told me, Tajul, can you raise 200 million BDT or 20 million BDT bond from the local market? I told them, if you are an export-oriented country, please give me the transaction. I will go to the foreign investor. Why? Number one, I know SEC may give me the permission. From where I will get the investor? So I cannot manage the investor except the banks. So again, when I go to the banks, there is a limit and other things, the capital market related number of list covenant is there for them. So this is all of these things actually make us the challenging for developing the corporate and bond market in Bangladesh. Now I give you a separate example from my experience. In 2019, I joined JICA to promote capital and bond market in Mongolia. So JICA hired me to advise Mongolia FRC to promote capital and bond market. So over there was no bond market at the time. So we provided some guideline and also advised them to promote a credit rating company in Mongolia, because bond market and rating company is very much go together. So they promulgated some rules and regulation. Then the COVID comes. And I'm giving you the idea, if you go to the website of the Mongolian Stock Exchange, over the last 1.5 years only after so there are $1 billion of Mongolian corporate open and close bond issued in Mongolian market. So they only allow for 18 months of bond. Despite that, corporate and the banks and the last year, their regulators signed MOU with IFC to promote the green bond. And last 3 months back, the largest bank in Mongolia, Khan Bank, they issued the first ever green bond in Mongolian market. So last month, I was in Mongolia for a month and 2 months to give 2 ratings of the 2 largest bonds. So I just share you the idea. So when the underwriter went to their FRC, their Security Exchange Commission, that we want to issue non-collateralized bond for the first time in Mongolia market. The regulator says, I would not like to see anything. I want your credit rating. Number 1. Without that, I would not like to hear anything from you. Then the regulator called the rating company 3 times. Tell us, show me your presentation, how you will rate it, how you will ensure your independence. I'm giving the real idea, how the regulator involved the total process to develop a bond market. So as a rating company, regulator invited 3 times presentation. Number 1 at their mid-level, second time their board level, and the third, there is an interesting aspect in Mongolia. All bond approval is given by the private sector committee. So there are private sector committee in the FRC, in the regulators, who are expert in the financial and other market. They sit together and give the approval of the bond, not the regulator itself give the approval of the bond. So that is the mechanism to develop. And they took 3 interview presentation from a rating company. How will ensure independence? What are your criteria? Then we provided the rating, and based on the rating, the last month it was listed, and within 45 minutes, the total was subscribed. So this is the example I'm giving how a bond market can be developed. Now the questions she mentioned rightly, the Sanchoy Patro rate, that is theoretically is fine, but within that position, is it not possible to develop bond market? Is it still possible? The problem is regulators, when we apply to the regulators for any bond and other things, they took little bit time and they want unnecessary things which does not they need to require. So that is important thing. So, and the second point is there is lack of investors. Why in the capital market, we act like a trader. So when all of your investor group, either institutional or individual, act like a trader, so they always look for capital gain. So I know a lot of asset management company and the top-notch security firm. I talked with them for one bond. I actually raised for 200 crore for a power project. I told them, why are not investing over there? Although how much money I will get, 8%, forget all these things. So this is the actually institutional investors mindset. So who will change it? The major question, who will change this, all of this problem? Actually, when the corporate people feel they need a longer term capital source from the capital market, then nothing can stop that one. So I should stop now. Thank you so much. So this is from my real experience I am sharing with you. Thank you.
Thank you. Thank you. You have, along with Dr. Sadia's points, you have added another point, that the willingness of the entrepreneur. So here we we know that like the entrepreneur has an easier access to the bank financing, even in spite of the acute problem of the mismatching of the deposit tenure and the loan tenure. So when that option will be available, so why I'll go for another option. So this is one of the challenging point we are in the context. So here we'd like to listen from Professor Dr. M. Sadiqul Islam about the credibility, like the issuer credibility, as the entrepreneurs corporate governance, even the corporate governance of bank and the corporate governance of the issuer of the bond or the trustee who will play the trustee institutional governance. And the one of the areas critically faced to mitigating the bureaucratic problem due to the lack of the coordination. So, sir, would you like to give some policy advice that how the governance of the issuer banks, because when the banks governance will be strengthened, then the mismatching issues will be mitigated. Then it will be difficult for the entrepreneur for getting long-term fund from the short-term deposit. So this is one aspect. Another is an issuer, the entrepreneur who will issue the bond. If they don't have then credibility, so their number can be manipulated and it will be not credible as well. Third is then corporate governance of the credit rating company as well. Like if we are not well governed, if we engage in the rating shopping, then our assessment of the entrepreneurs' financials will be also in a problem. And the regulators' willingness and the coordination. So, sir, how do you see the synchronization of the coordination and the governance of all these elements of the ecosystem?
Thank you, Dr. Mamun. Let me thank the keynote speaker, Dr. Sadia Afrin, for making an excellent presentation. And also Mr. Tajul Islam, he made very vividly very good points from his own experience from other countries and also in Bangladesh. Let me add few points. I mean, Dr. Sadia Afrin rightly pointed out the major problem in the bond market. The major problem I see that there is every potential to develop the bond market in Bangladesh. There is one major hurdle. That hurdle is interest rate rationalization. I mean, our government securities are paying high interest rate, government securities, government bonds and government savings certificates. These are sold at a very high rate of interest. As I noted it, it is 9.35% to up to 12% interest. That is simple interest though. If you make an average, it will be around 10% interest rate. So government bonds are paying 10% interest, and if a private company or a public limited company issues a bond at an interest lower than that, I mean lower than that rate of interest, why should people buy the bond? I mean, this is a very simple economics, but nobody listens to that. Policymakers are aware of this, but they never listen to it. They had a fiscal, I mean, the government has had to face the fiscal deficit, and they borrow from the market aggressively, from the banking system and also from the public. Now, the high interest rate of savings certificate, I mean, this is hurting the bond market so much. I mean, we could not develop from the nascent stage of bond market. So, is there any potential? Let me discuss the issues. Well, I'll talk about the issues that have been pointed out by Dr. Mamun. But before that, let me give a picture of the demand side and supply side of the bond market. Is there any potential for demand for corporate bond? Well, think about this. The government total investment in national savings certificate is about 3,64,000 more than 3,64,000 crore taka. So there is no demand for bond. That is not true. What is true is if the government bonds are available at higher interest rate, why should people buy the bond? That is from the retail investor or individual investor. From the institutional side, insurance companies have investment, probably this is 2021 figure, 45,724 crore taka. So they can invest in bond. There is no restriction on bond investments. They can, they are buying government securities. Even 25% or 25% of this comes to the corporate bond market, it will be 10,000 crore taka. Banks loan investment is 3,45,778 crore taka, and out of that 282,800 crore taka is in government security, and in other securities 62,978 crore taka. Now, banks, commercial banks have to maintain, have to buy government securities for their regulatory requirement, but they have other investment of in other financial instrument of 62,970 crore taka. So there is no demand for corporate bond. Well, that is not true. On the supply side, I mean, I was trying to make an assessment how much supply can be. I mean, as Dr. Sadia mentioned, it is a bank-based system, right? The corporates are borrowing from the banking system, but not by issuing bond. Why should they issue bond? If they have to issue bond, then they have to offer an interest rate that is higher than significantly higher than the interest rate on government securities. Now, as I can see, the scheduled banks, I was trying to collect the data of high volume loans. Scheduled banks have delivered 50 crore and above taka loan, taka 50 crore and above loan of 13,87,703 crore taka. I mean, a portion of it could come to the bond market because the banking system is allowing them to easy loan without any restriction on high volume loans. Now, what the problem here is, high volume loans are taken by the, I mean, say 1,000 crore taka loan, 2,000 crore taka loan, 3,000 crore taka loan. This type of loans are taken from the banking system indiscriminately and are being defaulted. So, I mean, corporates are not coming to the bond market. Some important points have been mentioned by Mr. Azul, that I mean, if they buy from the, if they take loan from the banking system, well, that is easier for them. I mean, the CIB issue is there. I mean, they can hide so many things and many other advantages they have. But if bigger loans are a bit restrictive, in that case, they have to come to bond market. So, I mean, there is potential for supply of bond, supply of corporate bond. But unfortunately, because of the interest rate, irrational interest rate, the bond market is not developing. Now, for example, 3,000 crore taka green sukuk had been issued by Beximco's to solar company, Tista Solar and Korka Solar. Only 2.16% of this sukuk is subscribed by retail investor, and the remaining 97 point something had been invested by institutional investors. Now, institutions, well, probably the issuer had some loan defaults in the previous years. That's why some institution might not have shown very high interest in these bonds. But it is not true that there is no demand for bond. Now, with respect to diversity, we have few. We have few. I have few things to mention. Well, about 35 to 40% of our banking system is Islamic banking system. Now, now the Sharia-based bond or sukuk can be an instrument that can cater to the needs of some particular section of people. Or zero coupon bonds are getting some tax benefit. Floating rate bond can be there. Foreign currency bond has some problem as well, because the foreign currency bond, if a foreign currency bond is issued, then the company may have to face the foreign currency loss due to exchange rate risk. So that's significant. For example, the exchange rate was 82 taka, one year ago, and that became 110 taka. You should understand the amount of burden that was imposed on the corporates for their foreign currency loans and bonds. So if foreign currency bond has to be issued, then in that case there should be a swap. Now there is no opportunity. Basically no opportunity for swap in Bangladesh. I asked the major banks. They said they are not going to make any swap. Previously, some foreign banks was doing the swaps, but they stopped doing this for some reason, and probably because of high risk. Foreign companies outside Bangladesh, well, they will not make swap. I had to explore this for other reason, but swap is not available, virtually not available. Now, Guaranco is providing guarantee for a particular type of bonds. Guaranco is a multilateral agency, and recently Guaranco has guaranteed Runner Automobiles bond. That was a green bond. That's why Guaranco provided a guarantee, and they charge approximately 2.5% for that. That is significant. Now, the cost will be imposed on the issuer. Now, as I said, until and unless interest rates are rationalized, this bond market will never develop. Or, the interest rate on government security must come down. You have to rationalize this. Why should people buy a corporate bond at a lower interest rate? Why risk is there? Now, at least 5% gap. At least corporates should provide at least 5% more return to the investor than the yield on government bonds. So anyway, these are the major issues. About the governance side, yes, the issue of transparency, well, it is not easy to manipulate the financial statements nowadays as it had been the circumstance 10 years back. Now the auditors are ranked based on their performance. The rating agencies are monitored, but I heard that some of the issues raised by Dr. Mamoon, that rating selling is taking place, meaning that some companies are giving rating. Well, I don't like to further details of it, are basically selling their rating. So if that is happening, that is something deterrent to the bond market development. So rating agency must play their role. Now, like the auditors, there are panel auditors from the Securities and Exchange Commission side. So about 40 audit firms are allowed to make audit of listed companies' accounts. So similar to that, the rating agencies should also be rated, and rated means they should be ranked based on their performance and credibility. And the corporates and other agencies should get their rating from the rated or ranked rating agency. That can solve the problem. But rating agency has a big role in this process. Now, the issue of self-registration, Bangladesh never had self-registration. Self-registration can be abused in Bangladesh market. But self-registration can be introduced. In the United States, the self-registration is given for 2 years. But maybe we can give self-registration for 1 year. That will reduce the issuance preparation and other formalities for bond issuers. If a company makes one issue at a certain time, the company can make another issue or 2 or 3 more issues next time at a very short notice. Now, probably I should focus on the mutual funds and provident fund. Mutual funds do not have any restriction on investment in bond. Provident funds can invest up to 25% of their fund in bonds or other securities, stock market securities. So that provision is there, but as you know, in Bangladesh, the government provident fund is not funded, so there is no fund. But the private sector provident fund, well, the amount is unknown. I could not get any data, as that Dr. Sadia got an idea, provided an idea about the possible demand for bond from the potential demand from the provident fund. Now, we have every potential for bond market, because the corporate financing should be bond based, not bank based. And when the market mechanism can work, corporates will issue bond. The market mechanism is not working. That's the main thing. And this message is well communicated to the policymakers. They know everything. There had been significant work on this, but the finance minister always say that, well, what will happen to the retail investors? There's oldest people who would like to get a very significant return, who should be given a significant return, and so and so. But the issue is, they also put a cap on the amount of investment inside National Savings Certificate. But the issue is that you can buy in your name, in your wife's name, in your daughter's name, in your son-in-law's name, and so and so. So that cap doesn't really work. So if the bond market has to be developed, this key problem has to be rationalized. The interest rate. Apart from this, the other governance issue, regulatory side is pretty much well framed. If we want to liberalize too much, there are other problems. So, for example, for the issuers, say for example, in the stock market, every issuer has to report the utilization, fund utilization. So do the bond issuers. The fund utilization has to be reported to this Bangladesh Securities and Exchange Commission every month. So what happens is, this requirement was done for some reason. I understand that these are some of the small hurdles, but the issue is, once upon a time, if you review the history of the stock market in Bangladesh in the 1990s, some companies issued securities and they fled away from the country. So these rules have to be framed like this. Yeah, it is a bit restrictive, but we should not relax this. But it's okay. The reporting things does not constitute too much of a burden. So anyway, probably if I could add a few points, I'll be happy. If you are benefited from my deliberation, I'd be happy. Thank you very much. If you have any question, I can also question to me. I can also answer that. Thank you.
Thank you, sir. Thank you for highlighting all the areas, I think, which covers, I think, the most of the areas. And yes, regulators and the policymakers are known to these areas, but when it comes from the expert like you, these are re-emphasized. So this is one aspect, and also all the participants definitely get the opportunity to refresh their memory and to connect all the dots have been discussed here. So now, may I request all of the participants, if anyone has any questions about this?
Sir, I can see a question in the question
Yeah.
box.
Yeah, could you read it?
So, yeah. Recently, FRC has taken some reform issues regarding the quality of auditor and audit reports. How could you realize this reform for capital market and bond market impact? It has been asked from MD Muhyiddin. So, sir, if you can address who can answer this.
So I think like it's an open to all. So, sir, if you like address this, I think sir has addressed.
Well, I mean, if you said that this has been raised by
FRC, sir.
FRC, right? Now, if that is required, then the regulatory agency, Bangladesh Securities and Exchange Commission, can revise their rule, and they can rank the auditors, or they can based on this requirement. Well, it will take, well, probably it will take few months or so, because they have some formalities in doing that. Hopefully that, I think that that will be done pretty soon. Very often I meet the BSEC people, and they are very much, I mean, in line with this. They are working for the development of this market, and definitely they will address that very soon. I mean, if FRC requires this, then well, there will be change in the regulation and change in the criteria how panel auditors are selected. So it is not going to be a big problem.
Okay, thank you, sir. So I have a particular question to Dr. Sadia. So one of the from the discussions, like it has been clear that there is a demand of the fund, and the bond market is one of the best solutions on considering the long-term requirement. As the statistics also projects that, like in the coming like 5-6 years, particularly up to 2030, almost $25 billion infrastructure fund requirement per year up to 2030. So in that respect, there is a demand of the fund, and the bond market can be a suitable solution. And on the supply side, one of the major supply side in the world market, in the world bond market, is the institutional investors. But in Bangladesh, still, we do not find any international institutional investors there operating. And SAR has also highlighted, because of that reason, our corporates are also going outside of the country, and they are bearing, or they are highly exposed to foreign exchange risks as well. So from that point of view, what are the initiatives regulator can develop or coordinate to attract the institutional investors to ensure the smoother supply of the fund and the options of the supply of the fund in the bond market?
Thanks. A very important question. I mean, this is one of the big area that we all should work. The ready institutional investor, apart from the banks, can be insurance. The current regulation allows in insurance, life insurance, to invest probably 10% of the funds in bonds and debentures, and 40% in land properties, স্থাবর সম্পত্তি। তো যে 10% আছে, এই 10%-এর যদি 1-2% যদি বন্ড মার্কেটে আসতো, That's a huge fund. I had an opportunity to do a workshop last year where I invited provident fund managers, insurance companies, mutual funds, and some fund managers also. So we asked the insurance companies. Their feedback was that they don't invest in bond market. They don't trust. They invest mainly in bank term deposit and in Shantrepotro and some other fixed assets. So even within the existing regulation, there is a scope to tap fund from insurance companies, but the insurance company itself has issues. There is no risk-based capital adequacy calculation in the insurance market. IDRA is developing, IDRA is working on this. So once there is a risk-based capital calculation, then insurance companies knows their risk-weighted assets, and then they can formulate the investment policy, right? How much to invest, how to diversify the risk. So, well, these are all very long term, but at least within the short term, I think the more awareness needs to be built within regulators as well as the industry. So insurance is the potential institutional investor. MetLife is investing. So our Jiban Bima Corporation, Shadharan Bima Corporation, they have huge fund, especially Jiban Bima Corporation. I talked to them. We have projects in the insurance sector. So I had chance to talk to Jiban Bima Corporation and IDRA as well. So they sometimes it's just lack of awareness. They don't feel the urge to invest in high return instruments and earn more money. So the awareness, knowledge, capacity, all things are needed. So if regulators are willing, they can try this way. And the other is the Provident Fund. So Provident Fund, it is true that 25% limit is there, but I think it specifically mentions about a stock market instrument, but I'm not sure it will allow corporate bonds or debentures, but it allows government securities, stock market, and anything that is backed by government guarantees, something like this. So this is again policy issues, as well as whatever the regulation allows needs to be utilized. And to attract investors, you need credit enhancement mechanisms or guarantor like Guaranco. So bring such guarantors in the field so that investors feel some assurance about their money, about their investment, and the legal framework is there, but that's not a short-term solution, right? In the insolvency framework, I think the bonds are not covered. In the Money Loan Court Act also, it doesn't give protection to investors in the bond market. It only considers loans, creditors in the banking sector. So there are some short-term and long-term solutions. I think, yeah, this is something in the short run, insurance, provident fund, that government should create more awareness or talk to potential investor. IFC, IFC invested in a housing bond by Bragg Bank last year. So that's a demonstration transaction, and it's not always easy to get partners in the local market. Investors. I talked to many provident funds. I was asking, why don't you come to bond market? So why we should gamble with our money? Why should we come to bond market? It is risky. It is our provident fund. The people will use this in their retirement. Why should we invest it in the bond market? It's gambling. It's risky. So you see, so you need to build confidence, and confidence depends on a lot of things, and there's no easy solution.
Yeah, thank you. And definitely one of the instrument is the role of the credit rating company, and BDRL as a DNB company is very keen to ensure the credible credit rating for
That's
building the trust.
Role you have in the market to build confidence.
And like BDRL is really keen and very careful to ensure, and that's why our motto is to ensure the credible credit rating for the sustainable corporate growth as well as an economic growth. So I believe that we will get more opportunity to contribute to provide our credible credit rating services. So, sir, at this moment, like or Tajul bhai, is there any concluding comment from your side? I think it's already 9.
Just one thing. I mean, Provident fund, 25% of provident fund can be invested in stock market securities. I knew that stock market securities include bonds as well. In the stock market, bonds and shares, preferred stock, all these are traded. So that will include everything. So I think bond is included in that. Thank you.
Okay, thank you. Thank you, and thank you very much. Thank you. Is there any concluding comment from Dr. Sadia or Tajul Bhai?
No, thank you very much for organizing this kind of initiative. It is one of the role to share the knowledge into the market. So yes, we know more professional knowledge-based system in place. So then automatically bond market and everything will be developed, because last 20 years we are discussing about the bond market
Thank you.
development.
Thank you, Tajul.
Yeah.
Yeah.
Thank you so much.
Thank you. Thank you. Thank you, Tajul Bhai. Dr. Sadia, like if you want to make any concluding
Yes,
comment.
just very briefly, I want to thank Mr. Tajul Islam. This is really true. I mean, what is the incentive to go bond market and expose myself? So that's why we need to create the incentive. If you remember, I mentioned one point that we need to manage the concentration risk in the financial sector, which is beneficial both for the banking sector as well as for the bond market. In India, there are policies like this that restricts the bigger borrowers, bigger firm, when they go beyond a certain limit to borrow from bank, the banks impose higher cost in terms of high provision requirement and high risk weights to those loans. So these are the market mechanism that has to be in place that will incentivize the bigger borrower to automatically go to the bond market. Otherwise, they'll never go. Bank borrowing is always easy. They already have a good relation with banks. So why should we go to the bond market and take all the hassles of applying here and there, running for the approvals? So there has to be market mechanism. But you are right. Currently, there are incentive issues. Thank you. And I'd like to thank everyone. This is a great platform, and thank you for inviting me. These are really great issues. And the panelists, Professor Islam, Mr. Tajul, you made very good points. It's very helpful. Thank you very much. Dr. Mamoon, Samira Sohani, thank you very much.
Thank you. Thank you so much.
Thank you. Yeah, thank you, everyone. I believe that like we will get BDRL and the team BDRL will get your continuous support and encouragement because we are very committed to play our due role with maintaining highest level of the professionalism and due care, because we believe that we are providing services to the client, but ultimately that hits to the financial sector and economy at the end. So for your continuous support, inspiration, and guidance, BDRL would like to move forward with his vision. So thank you very much, everyone, every participants, panelists, and keynote speaker. And good night to everyone. See you in the next program.